For more than a decade, the Japanese yen has been the go-to funding currency for global carry traders. Its ultra-low interest rates made it the perfect tool to borrow cheap and invest high. USDJPY became a favorite, almost a reflex for seasoned traders chasing yield. The strategy was simple: short the yen, ride the interest rate spread, and pocket the difference. But 2025 is a different world. Central bank dynamics are shifting, global capital flows are evolving, and the very foundation of the JPY carry trade is starting to crack. If you're still betting against the yen like it's 2012, you might be walking straight into a financial minefield. Stay with me, because what I'm about to share could save you from making a costly mistake. First, a quick disclaimer. This video is for educational purposes only. I am not a financial advisor, and nothing here should be taken as financial advice. What you're about to hear is my personal view based on research, experience, and market observation. Always do your own research before making any trading or investment decisions. Welcome to Markets and Global Trends. Intro: Shrinking interest rate differentials. One of the key JPY carry trade was the large interest rate differential between Japan and other major economies like the US and the Eurozone. However, as Japan raises rates, this gap is narrowing. The profit potential from borrowing in JPY and investing in higher-yielding assets is no longer as lucrative as before. Back on February 16th, I published a blog post titled, "Why JPY is no longer a good funding currency in 2025." In this video, I'll go deeper into the exact reasons why I believe the Japanese yen is no longer safe for carry trades. Let's start with what changed. For over a decade, the Bank of Japan kept interest rates near zero or even negative. It was a dream scenario for carry traders: borrow in yen, invest elsewhere, and pocket the spread. But in March 2024, the dream began to unravel. That month, the Bank of Japan raised interest rates for the first time in 17 years. A historic shift. And it didn't stop there. Another rate hike followed in July 2024, and again in January 2025. Today, the Bank of Japan's benchmark rate sits at its highest level since 2008. Why this sudden shift? Simple: inflation and wages in Japan are finally rising. For years, Japan battled deflation, prices going down, not up. But in 2024, that narrative flipped. The Bank of Japan is now playing defense, raising rates to cool inflation and stabilize the economy. And the impact? Immediate. The yen started to strengthen. Japanese government bond yields, especially the 2-year GGB, began climbing. Suddenly, borrowing in yen wasn't so cheap anymore. For the first time in decades, the JPY carry trade is no longer a free lunch. One of the reasons currency pairs trend is central bank interest rates. I'm going to give you 3 examples of the Fed and Bank of Japan to prove my point. Example 1, Abenomics and the yen's weak era. To really understand how we got here, we need to rewind to 2011. Japan was facing a perfect storm: slow growth, persistent deflation, and a currency that was too strong for its own good. Then came Shinzo Abe, elected as prime minister in late 2012, armed with an aggressive economic revival strategy. The world would come to know it as Abenomics. Abenomics was built on what Abe called the 3 arrows. The first arrow? Massive monetary easing from the Bank of Japan. The second? Fiscal stimulus through government spending. The third? Structural reforms aimed at boosting productivity and long-term growth. But it was that first arrow, monetary easing, that really shook the markets. The Bank of Japan, under Governor Haruhiko Kuroda, pulled out all the stops. They launched unprecedented levels of quantitative easing. They promised to overshoot the 2% inflation target. And in January 2016, they took the radical step of moving interest rates into negative territory. That decision marked a turning point. Borrowing in yen became essentially free, even profitable in real terms for some institutions. Global investors piled into carry trades, borrowing in yen to invest in higher-yielding assets abroad. And the results? Clear as day on the charts. From late 2012 to mid-2015, USDJPY surged, rising from around 80 to over 125. It was one of the most powerful bullish moves in recent Forex history, driven almost entirely by the monetary divergence between the Fed and the Bank of Japan. The yen wasn't just weak, it was designed to be weak. And for carry traders, that era was golden. But here's the thing, that era is over. Example 2, the Fed's awakening into 2022 after years of ultra-low rates and quantitative easing across the globe during and after COVID. something dramatic happened in March 2022. The US Federal Reserve, after insisting for months that inflation was transitory, finally changed its tune. Inflation in the US was no longer just a headline, it was a crisis. So, on March 16, 2022, the Fed pulled the trigger. It raised the federal funds rate by 25 basis points, its first hike since 2018. That one move opened the floodgates. Over the next year and a half, the Fed embarked on one of the fastest and most aggressive tightening cycles in modern history. Rate hikes came thick and fast, 50 basis points here, 75 basis points there, until the benchmark rate soared past 5%. And what did that mean for the markets? It meant the interest rate spread between the US and Japan, the same spread carry traders watch like hawks, was now wide open. While the Bank of Japan kept rates negative, the Fed was racing ahead. USDJPY surged. From early 2022 to late 2022, the pair exploded from around 115 to above 150 levels not seen in over 3 decades. This time, the carry trade was driven not by Japan's weakness, but by US strength. Yet even then, change was brewing in Tokyo. Example 3. The Fed blinks as 2024 came to a close. Something subtle but monumental happened. The Fed blinked. In December 2024, the Fed announced its first rate cut. It wasn't a huge move, just 25 basis points, but it marked the beginning of the end of the tightening cycle. Why? Inflation had cooled, the labor market was softening, growth was slowing, and the market, it reacted instantly. USDJPY hit resistance hard. That 156 to 160 range became a ceiling. Every attempt to break higher was met with rejection, because the rate gap that drove the pair higher, it wasn't widening anymore. The Fed was stepping back, and the Bank of Japan was just getting started. For the first time in years, the carry trade had lost its engine. Japan's CPI surprise, more hikes ahead. Then came March 27, 2025. Japan's latest CPI data dropped, and it was hotter than expected. Inflation, not just headline, but core, was well above the Bank of Japan's comfort zone. Prices were rising across wages, services, and domestic consumption. The Bank of Japan's fight against inflation isn't over. More rate hikes are coming, and every hike shrinks the interest rate gap that made shorting the yen so attractive. Still betting against the yen like it's 2015? You could be walking into a trap. Politics meets policy. Trump vs Powell. And just to make things more complicated, here comes politics. Donald Trump is back in the spotlight, and he's pressuring the Fed hard to cut rates now. He wants a weaker dollar and faster growth. But Jerome Powell is holding the line, at least for now. If Trump wins this battle and forces deeper cuts, the dollar could weaken fast. Pair that with Bank of Japan tightening, and shorting the yen becomes one of the riskiest trades of 2025. Trade idea: short CHFJPY. Now that we've built the macro case to be long JPY, which pair makes the most sense? For me, it's CHFJPY. Why? Because while Japan is hiking, Switzerland is cutting. The Swiss National Bank has already slashed rates to weaken the franc and support growth. As a swing trader who holds for days or weeks, I avoid paying heavy swap fees. Shorting CHFJPY pays me to wait, and I don't chase breakouts. I short the spikes, the emotional moves, the overreactions. That's where I find the best entries. CHFJPY is the perfect form: a weakening franc, a strengthening yen, and a divergence setup with strong macro backing. This isn't just a trade, it's a macro thesis playing out on the chart. Want me to break down other currencies, macro trends, or stock indices? Drop your thoughts in the comments, I'm listening.